So, you've probably seen all the headlines about mortgage rates, right? They're up, they're down. But what does that number on the screen actually mean? And what forces are really pulling the strings? Let's break it down and get to the bottom of it. All right, here's the number that's been making all the noise this week, 6.26%. You've probably seen it or something pretty close to it popping up in the news. It might just look like a number, but it has a huge, real-world impact on millions of people. So what is that exactly? Well, that's the latest weekly average for a 30-year fixed mortgage in the US. You know, the kind of home loan most people get. It's basically the benchmark for what it costs to borrow money to buy a house. And look, this isn't just a one-off thing. This is the third week in a row that we've seen rates creep up. That's a trend, and it's worth digging into what's going on. But a single number or even a 3-week trend doesn't really give you the full picture, does it? To really get what 6.26% means, we've got to zoom out a bit and get some context. Just look at how much things have been bouncing around lately. Today's rate is up from a yearly low we saw just 3 weeks ago. But here's the kicker. A year ago, rates were actually higher than they are today, at 6.84%. It just shows you how fast things can change. So what's the big takeaway from all this? Beyond all the weekly ups and downs, the bottom line is that we've been living in a world of 6% plus mortgages for a while now. Those super low, sub 4% rates, yeah, they've been in the rearview mirror for over 2 years. All right, so that's the what. Now let's get into the why. What is actually pulling the strings behind these numbers? Now, I know what a lot of you are probably thinking. We always hear about the Fed raising or cutting rates, so they must be the ones setting mortgage rates. Makes sense, right? But is it really that simple? Well, it's a bit more complicated than that. The Fed's decisions have an indirect influence, for sure, but they don't dial in your mortgage rate directly. Instead, mortgage rates tend to follow the yield on the 10-year Treasury note. Think of the Treasury yield as the economy's mood ring. It tells you how investors are feeling. When they get nervous, that yield goes up, and mortgage rates almost always follow right behind it. That's the number you really want to watch. And if you need proof that the Fed isn't directly in control, check this out. Just last fall, the Fed actually cut its key rate, so mortgage rates should have gone down too, right? Nope. They marched in the complete opposite direction, all the way up past 7%. So if it's not just the Fed, what is it? Well, it's really a whole cocktail of factors. The 10-year Treasury yield is the big one, but that's influenced by what the Fed is doing, how investors feel about the economy, and what everyone thinks is going to happen with inflation. They all work together. Okay, let's bring this all back down to earth. We've talked about the numbers and the mechanics, but what does this all mean for you, for someone who's actually trying to buy a house? At the end of the day, it's pretty simple. When rates go up, your buying power goes down. It means that for the exact same monthly payment, the amount of house you can afford actually shrinks. It's a direct hit to your budget. And you can see the impact clear as day in the sales numbers. Historically, we'd see about 5.2 million home sales a year in the US, but the pace lately, it's dropped all the way to around 4 million. I mean, that's a huge drop in activity. And all of that adds up to the housing market we've got right now, one that you hear experts call sluggish all the time. It's pretty straightforward. Fewer people can afford to buy at these rates, which means fewer sales, and the whole market just slows down. All right, so this brings us to the million-dollar question, right? Where do we go from here? What are the markets and the experts saying is next for rates? Well, in the short term, things are murky. Wall Street seems completely split. Right now, traders are pricing in about a 44% chance of a Fed rate cut in December. That's basically a 50-50 shot, a total coin toss. It just goes to show you how much uncertainty is out there. And believe me, this stuff can change on a dime. Just a couple of weeks ago, that same probability of a rate cut was nearly 70%. To see the odds drop that fast, wow. It just hammers home that nobody's really sure what's coming next. But if we look a little further down the road, the experts are starting to sing a similar tune. Major groups of economists are forecasting that the average 30-year rate is going to cool off a bit and maybe drop back down to around 6% sometime next year. And that, of course, leaves us with the big final question. Look, a drop to 6% would definitely help, no doubt about it. But with home prices still so high, and after years of this slowdown, you have to wonder, is that small drop really going to be enough to unfreeze the housing market? That's what everyone's waiting to find out.